There are four common types of external funding for startups. 1. Investment by family and friends. 2. Angel investment. 3. Seed capital investment. And 4. Venture capital investment, also called VC investment. You should only seriously consider friends and family if any of them are really rich and they don't mind losing what they put in. Otherwise, skip this option. Consider angel investors instead. This is an investment by a wealthy person, perhaps an entrepreneur who divested a business he or she owned and now invests part of their wealth in new startups. Their investment amount is typically within the range of $10,000 to $250,000 USD for 5 to 15% of your startup. Angels normally act very fast on their gut feelings and will not ask for too much control. Angel investment is used to build early credibility. The next level of investment is seed capital. Seed capital investors are professional funds backed by several partners. They typically invest $50,000 to $2 million US for 10 to 25% of your startup, and most often require a board of directors seat. Seed capital is used to move a startup from the concept stage, where there is already a minimum viable product, into a preliminary stage of commercial operation. The next level of investment for your startup is venture capital. Venture capital funds do not invest in the early stages of a startup. They typically wait until there's a proof of concept and the ability to generate revenue. Venture capital is normally divided into 3 rounds, and you'll sell 20 to 30% of your shares in each one. Round A, which is typically $1.5 million to $5 million USD. This money is used to facilitate the commercialization of a product after significant growth has been proven in at least one market segment. Round B is typically $5 to $50 million USD and used to facilitate wider commercialization and further product development. Round C, which is typically above $50 million USD. It's used to grow the company quickly and prepare it to be acquired or become publicly listed. Venture capitalists demand board seats, insight, and control over certain aspects of the business. One of the most crucial aspects of fundraising is the valuation of your startup. That number, the value, determines how much cash you can raise for how big a percentage. Some investors value a startup by comparing it with similar companies. Others are more concerned about its potential for future earnings. But the value of a startup can also be unrelated to its future income. Many of the unicorns didn't have profit, let alone break even before they raised hundreds of millions of dollars. In earlier rounds of investment, the shares you sell are sometimes not physically issued. Not at the time, anyway. They take the form of simple stock options or convertible notes that can be converted into shares at a later time at a pre-agreed price or at a certain discount that's agreed upon up front. Sometimes new investors demand a minimum return in the case the company is liquidated or sold. Such protection is executed through preferred stocks, which are different from ordinary stocks that have no special rights. These preferred stocks can make future fundraising more difficult. Make your fundraising an event with a beginning and an end, something that gives your potential investors a sense of urgency. A good idea is to have a checklist with your preferred terms in front of you when you negotiate, but be sure that it has been vetted by your lawyer. A term sheet is normally agreed upon before a final contract is signed. A real contract will only be signed after the investor has completed a satisfactory due diligence investigation of your startup. Due diligence usually includes assessment of financial data and other performance metrics, official documents, agreements, market data, and so on. The best way to find investors suitable for your startup is to identify other startups that have already been funded and investigate who their investors are. It's important to understand that investors and startup founders choose each other. The perfect investors have their hearts in the startup business and bring more than just money. For example, other intangible yet invaluable contributions can include startup knowledge and expertise in your industry, as well as access to networks. Go for investors who are able to participate in further investment if needed. What happens down the track if you succeed? Some 7 to 10 years into commercial operations, the logical next step is that your company is acquired by a private equity fund or a larger company or taken public in an IPO. But no matter what kind of wealth you imagine may lie ahead of you, do not let that distract you. Focus on building an amazing company. That's your best guarantee of success.